Solid US inflation means the Federal Reserve could pause rate cuts in December. The Reserve Bank of New Zealand cuts by 50 basis points, with questions arising over its next move, and underlying inflation ticks up in Australia. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner sums up the state of play for Kiwi interest rates, with the Reserve Bank of New Zealand's next decision not until February.
Despite the Governor's comment that their baseline is a 50-point cut in February, we're still forecasting 25 because we are definitely seeing signs of life in this economy in response to the rate cuts that we've already seen.
But first, in 5 and 5 with ANZ, US equities fell overnight as a solid, although expected, inflation print meant questions remain over whether the US Federal Reserve will cut again or pause in December. At 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.5%. US Treasury yields were also down by 4 to 6 basis points. And the US dollar was down 1% as traders grew more wary about Trump's tariff policy. The Fed's preferred PCE inflation measure rose 0.2% in October and 2.3% for the year. That was in line with expectations. But core PCE rose 0.3% in the month and 2.8% for the year. That was ahead of the FOMC's forecast that core inflation would end the year at 2.6%. ANZ Head of G3 Economics, Brian Martin, says an underlying disinflation trend remains intact.
It's a real balance call. We think that the labour market report due on Friday week will be very important in determining whether or not the FOMC will pull the trigger with another 25 basis point rate cut in December. If the labour market report shows that private hiring is still really quite weak, then I think that will be a green light for them to go ahead, because from the labour market they would then be taking quite clear signals that it is not a source of inflation anymore, and therefore that other parts of inflation may well be transitory. I think if you get quite a strong labour market report that was to be in excess, say, of 300,000, suggesting that all the jobs that didn't materialise in October were added back in November, and indeed you had strong job gains for that month as well, well then I think the probability of a skip would definitely increase. For the moment, though, the market is still very much biased towards a rate cut, and indeed that is our penciled-in forecast. The market is currently pricing between a 60 and a 65% chance that the FOMC will cut rates 25 basis points when they next announce their decision on the 18th of December.
That US dollar weakness saw the Aussie up 0.3% at 64.92 US cents at 4 a.m. Sydney Melbourne time, while the Kiwi was up 1.16% at 59 US cents, after markets saw the RBNZ's comments as a bit more hawkish than expected, at least initially. Number 2, the Reserve Bank of New Zealand cut rates as expected by 50 basis points to 4.25% yesterday. But as ANZ New Zealand Chief Economist Sharon Zollner explains, the move wasn't all smooth, with exchange rate and interest rate volatility on the day as the market picked through the differences between new forecasts and comments from the Reserve Bank Governor.
One is that the Reserve Bank's own forecast for the official cash rate suggests the sort of 50-50 odds of whether February's cut would be another 50-point cut or a smaller one. They also noted explicitly that future cuts were conditional on economic data evolving as expected. Now, technically that's always true, but that may have been taken by some as a hawkish warning. But then at the press conference, the Governor noted that, in his view, the OCR track was consistent with a 50 basis point cut in February. So we saw something of a retracement of those earlier increases.
And we'll have more from Sharon in today's deep dive. Number 3, Australia's headline CPI inflation rate held steady at 2.1% in October, below market expectations for a rise to 2.3%. But as ANZ senior economist Catherine Birch explains, this masked a 30 basis point rise in underlying prices when temporary government cost of living support is stripped out.
A lot of the downward pressure on headline inflation is coming from those electricity rebates, which have seen electricity prices fall 35% since June. In October, we saw a further 12.3% fall in the month in electricity prices, and over the past year, they're estimated to have taken 0.9 percentage points off headline inflation. So if we take a step back and exclude the electricity price changes and other volatile price changes, the annual trimmed mean inflation measure actually rose to a 3-month high of 3.5%.
Number 4, Catherine says though, that the trend in trimmed mean inflation is still downwards, something the Reserve Bank of Australia will have been looking for.
It can be a bit bumpy, but overall the trend suggests that we're continuing to see this broad-based disinflation. It's also not directly comparable with the quarterly CPI, so we do need to look through a little bit of the bumpiness in the monthly indicator there. But on first glance, it does look consistent with what we're looking for the Q4 print, which is a 0.7% increase in trimmed mean inflation and a 3.4% increase over the year. But when we get the November data for the monthly CPI indicator, that will give us a better gauge of how things are tracking in Q4.
Number 5. Construction activity in Australia over the third quarter made a stronger than expected rise of 1.6% from the second quarter. That was 4 times the market expectation for growth of 0.4%. ANZ senior economist Adelaide Timbrell says Q2 growth was also revised up considerably from 0.1% to 1.1%.
Public sector engineering construction is the reason we've seen strong growth in construction work done over Q2 and Q3. But the most direct input into GDP, private sector engineering construction, only picked up by 0.5% quarter on quarter after 2 consecutive declines, which cumulatively added up to 3.3% falls in H1 of 2024. That's the part where we're looking at going, okay, just because we're seeing this really strong public sector growth doesn't mean we're necessarily going to be seeing a really strong GDP result out of this data.
Adelaide Timbrell there. Now, for our deep dive interview, after the Reserve Bank of New Zealand's last rates decision until February, ANZ New Zealand chief economist Sharon Zollner sets out why she expects the RBNZ will only be cutting by 25 basis points in its first meeting of 2025.
Despite the volatility, we didn't see too many surprises in the monetary policy statement, really. They did revise down their growth forecasts a little, but unfortunately they were also quite pessimistic about the outlook for productivity growth and also taking population growth into account. They now think the economy can't grow as quickly without generating inflation pressure. So actually they revised up their forecast of non-tradable inflation a little bit. Not too meaningful. But again, just a reminder that future rate cuts are indeed conditional on how the data evolves. And we're going to get a lot of data before the next decision, 12 weeks of it. So despite the governor's comment that their baseline is a 50-point cut in February, we're still forecasting 25 because we are definitely seeing signs of life in this economy in response to the rate cuts that we've already seen.
Are those signs of life implying that the Reserve Bank may have gone a little bit too far with its downward forecast revisions?
The Reserve Bank is confident they've done enough, and there's good reasons for that. The economy is very weak, and inflation lags the real economy considerably by 6 months or even more. So the weakness that is in the bag is yet to fully feed through into inflation. So the hurdle is probably pretty high for the Reserve Bank to become concerned again about domestic inflation. But it is still true that the starting point for domestic inflation is too high. It's nearly 5%, and tradable inflation of minus 1.6% has been doing quite a lot of the work, and that's not really something you can rely on in the medium term. Now, the New Zealand dollar has been looking a little wobbly lately. If that were to fall out of bed, then suddenly that tradable inflation could turn around quite quickly, for example. So everything is conditional, but I don't think the Reserve Bank would be worried about the economy bouncing back a little quicker than expected, because they do estimate that there is a lot of spare capacity in the economy here and now.
And then where do you see interest rates hitting over the cycle? Is that the same?
Yeah, we have not changed our forecasts. We continue to expect 25 basis point cuts at the next 3 meetings, taking the OCR to a trough of 3.5%. So that is a little bit more hawkish than the Reserve Bank's own track, which is slightly more front-loaded and takes the official cash rate down to 3%. There is a lot of uncertainty about where things will end up, but there are just some signs of stickiness in some prices, both domestically and internationally, that we've put a bit of weight on.
And what were those indicators that show activities picking up?
So business confidence is at a 10-year high, and it's taken investment and employment intentions with it. Anecdotes out of the dairy sector are very strong. The auction clearance rate for residential property has lifted substantially, and sales and prices are perhaps going to move. The Reserve Bank did revise up their house price forecasts a little bit. This week we will get updated reads on both business and consumer confidence. So that'll of course be interesting to see, but with 12 weeks until the next decision, pretty much every data point you can think of is going to be delivered. GDP, CPI, of course the monthly inflation and activity indicators, and even another fiscal update. So although the governor commented today that a 50-point cut in February is the baseline, 12 weeks of data will always trounce any comment made 12 weeks earlier. The data will decide.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, November the 28th. Catch you tomorrow with today's career rate decision and the latest ANZ Business Outlook results in New Zealand. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.